Stocks continued higher today with a new move to the upside. Where is kind of our limits as to how far it can go up? Of course, there's no limit to overbought or oversold conditions, but there's precedence in the past as to how far. I'm going to kind of show you some of those today and what we can expect and when we can expect to kind of run out of gas. Not necessarily that we have to tank, but just to kind of run out of gas based on past precedent. Excuse me. So I'm also going to break down this kind of this risk appetite pullback that we're getting that we don't think we're getting because the S&P continues higher. It's kind of a small scale of this bigger move that we've had where all these other risk trades have been declining sharply except for the S&P on a big long-term scale. All the way up until this fall, this summer, where we bounced. We've been rallying ever since. On a small scale, we've already seen other things pull back, except for this. And I'm going to show you that, and I'm going to show you a way to kind of reduce your risk a little bit as we do get overbought in the short term with our trade idea today. So let's go ahead and get started. Today is Monday, November the 18th, 2019. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator. We got a new new all-time closing high again today on the S&P. Smaller range, so that brought the momentum line down, but because we were bullish, it kept the near-term line going up. So the near-term line and intermediate lines really are extreme levels here, one day after getting an overbought cluster. We are well up above the 30-day moving average. In fact, I tweeted out, for those who follow me on Twitter, I tweeted out earlier today that we are more than 2.5% up above the 30-day moving average. So that green line here, we are more than 2.5% above that. That's kind of a key level. As you can see, it's not too often that we get higher than 2.5% away from the moving average, and when we do, the orange lines are the moves that have come off of death crosses. So these drops produce death crosses on the 50 and 200-day moving averages. So it was right here, and then these two over here in late 15 and 16. So the moves, not surprising, the moves coming off of significant lows like that took us well up. But the rest of these are all kind of bull market moves, where, I mean, we had some pullbacks, but we jumped up, and they're highlighted all here with the blue lines that correspond to these other levels. So kind of gives us an idea of what we can expect. I also tweeted out too that this move, excuse me, this 8% move pretty much that we got right here without a single 1% pullback in here, essentially is the fourth biggest move in the last 5 years. With the VIX at the time of that low point was at 20. Two of these other three, the VIX is really high. So it kind of shows again just how extreme we were in January of 18 by the time we had peaked. The VIX, when we started that 12% run without a single 1% drop, the VIX started that run at 13. So again, kind of shows how extreme and how we are not even close to that kind of a move right now. And you remember that was a tax reform, and nobody wanted to be caught not being bullish with the tax reform coming out and being implemented at the beginning of the year. The others here are just pullbacks that we bounced off of, and the VIX had gotten up to the low to mid 20s, similar to where we're at here, and we jumped up 9%. And as I mentioned before, I compare the move we're getting right now to this move where we moved up almost 8%, and we finally got, after expiration, a 1% pullback, and that's kind of the expectation here eventually, pulling down, in this case now, to 30.69, and that's a moving level. As we continue to move higher, you have to move the Fibonacci levels higher. But a move to 30.69 from where we're at right now, just to kind of give you an idea of what kind of percentage move that would be. That would be a 1 2/3% drop. So again, very similar to what you saw here. So we'll see if that ends up being the case, if we end up getting that. But we continue to slowly plug our way higher. Not on the Russell though. You notice the Russell is not getting new highs. We peaked on November the 5th. It's now November the 18th. We're still declining. The near-term line is up, but not in the upper reversal zone like it is on the S&P, and for that matter, everything else. Look at the NASDAQ, look at the Dow. So the Russell's really not participating here. So we've seen this before when the Russell doesn't participate with the rest of the risk appetite move. That similar move that we had, you notice in June, we had dropped coming into the expiration. So we had already started to pull back before the S&P did. It took a day after. And so we're seeing that here as well. And there's plenty of other instances where the Russell 2000 turned before the S&P 500 turned. If I pull up a comparison with the S&P 500, you can kind of see the weakness that occurs in the Russell before it finally occurs in the S&P, and the weakness that occurs here before it occurs in the S&P, and same thing here, the weakness that occurred in the Russell right about the same time that it occurred on the S&P over here. It pulled back before the S&P did. And here's the divergence again. The Russell's dropping, the S&P is continuing up to new highs. That divergence you would expect at some point in time to get rectified. It's going to get rectified in one of two ways. Either the Russell's going to break up and catch up, or the S&P is going to come down and catch down. And again, it doesn't have to catch down a lot, just enough to allow the Russell 2000 to bounce up early and catch up itself, and then away they go again together, as you expect them to. Okay, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of your screen. Hit that red subscribe button that pops out. There's also one down below the video if you're watching this on YouTube. That will notify you when these videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us two things. Number one, you liked the video today. It's our survey. So we look to see how many thumbs up we get for how many views to see whether or not you liked it. And a thumbs up also means that you want us to do it again tomorrow. So if that's the case, click the thumbs up. If you don't want us to do it anymore, then let us know by not clicking anything down there. And also while you're down there, comment. What did you get out of our video today? We always love to hear anything that you got out of it specifically and what you learned. Join our website at marketscholars.com. There's a link popping out right there in the top right corner of your screen. Click on that link. It takes you to our free subscription page where you get access to our Market Outlook community forum, as well as our market commentary blog section, webinars that we do on occasion, other things there. So you can subscribe with that link, as I mentioned, for free. Follow me on Twitter for more content, market commentary type content, as I showed you before in between these videos, and join our Facebook group our Market Outlook Facebook group that we've created. All right, if you're watching this on our blog, there's a lot of things on this page. We invite you to check us out. Check out our classes that we have. We have 8 trading rooms we do every week. They're listed. The upcoming events are listed here. We also do live Market Outlook videos where we put on the trade idea before the market closes. We manage old trade ideas that we're still in all the way up to the time we close them. You can check us out with our monthly subscription plan. There's a link there that gives you more information to that above the video. Below the video is our social media. We invite you to engage with us there. That will ensure that Twitter and Facebook promote our content at the top of your timeline, and make sure you get our stuff that we tweet out and post throughout the day. So they'll show you the stuff you engage with. So we try to make it really easy for you to engage with us. Just hit this little heart. It opens up a new window. You can like today's Market Outlook tweet. Click this image with a thumbs up, and that will take you to your Facebook account, and you can like today's Market Outlook Facebook post there. Really easy to do. All right, now let's take a look at the long-term view, and you can see a good bullish Heikin-Ashi candle. We're not anywhere near the low point at 30.75 where we start to get any kind of transition candle out of this. You also see we're kind of flirting, and that's kind of what I talked about on Friday is, as bullish as this is so far this week, one day, mind you, we're still not closing above the high, last week's high, 31.20. or the Hakinyashi close itself, which is an average of this week's actual open, high, low, and closes. The average of those four prices is the Hakinyashi close. So to get that to close above 31.20 would be a bullish week, and I don't think that we will get that. I think we'll start, again, very similar to that June time frame over here, where we'll have a little bit of it may just be 1 week, but I think it'll be maybe 1 or 2 weeks where we kind of stay below the prior week's high point, and then we break out and continue the intermediate trend back to the upside. Again, considering how long we've been in this bullish trend. If you take a look at the 3 green arrows, you can see we're back to 3 green arrows. We're still trading well above the 8-day moving average. The buyers are well in control according to the stochastics. Momentum is strongly bullish. Don't expect the histogram to get very big now. This was the initial run, and now that the actual MACD is so high and its moving average is so high, I expect really small histograms. That's the norm for how this works. You get that initial thrust and then it gets really small. Initial thrust, it gets really small. Initial thrust, and then the rest of the time it's really small. So, but the key is to watch the orange line, and when it starts to make the run to the downside, that's when we start to get the intermediate pullback. And obviously we're not there right now. Now you watch the blue line and kind of flirt around with where the orange line is, high at really high levels. In fact, in our Market Outlook Live that we did earlier today, always at 3:30 Eastern Time, we talked about how I reconcile the fact that we are so bullish in the short term, and I expect these pullbacks, with the fact that I also am still really bullish in my class portfolios that we trade here in our active trading classes or trading rooms. They're pretty strongly bullish. So how can you have strongly bullish portfolios with a bear kind of a pullback expectation in the short term? And how do you reconcile that with actual moves that you do instead of just pure talk? So I kind of talked about that today in the Market Outlook Live, and you'll see a little bit of that in the trade idea here at the end of the video. Let's take a look at the intraday chart here. And you can see, we've got a new high, the new 4-week high point. The low point is going to be stuck there for a couple of days, and then we'll gradually move up by the end of the week up to this level. By next week, by next Monday, we'll have our low here at the 301. That will probably push this up towards this node at 307. So you can see just how bullish we are. I mean, we are trading above or trading at the top of the value area in the 4-week, above the point of control, which is sitting right at the 309. In fact, I'm kind of watching that 309 level. If we pull back on any basis, 23% retracement level, I mean, if I kind of take a look at what that looks like here. So here's the low point on 10.8. So if I draw my Fibonacci lines here, and let me just throw this on open, high, low, and close, and snap it to that low point there, and then we'll snap it up to this high point up here. Then you can see here, let's throw on a 23% Fibonacci retracement level on SPY. That essentially gets us to the point of control and a little bit below it, to the bottom of this little volume area. You break through that, and then the next volume node is sitting right at the 38% retracement level of this big, long, near-term run that we've had right now. If we take a look at today's volume, remember we were above average volume on Friday and above average trading range. Well, the volume dropped down to below average at 49 million, and the range dropped considerably down to 1.25 points. So when you put that in the context, 49 million is way down here. 1.25 points is off the chart to the downside. We look how low the ATR is relative to the current price, way below 1%. So that is bull market entrenched there. And you look at volatility. Volatility actually jumped up with the expiration on Friday. But keep in mind that we didn't, that didn't really jump. Like, we didn't get a jump in volatility today. It's just a changeover of different contracts that the VIX is trading. But you can see that it fell throughout the day, as it generally does. For the most part, falls throughout the day, and is still right around the 80, in the lower end of the bullish range. So again, strongly bullish, and right now the 85% level is acting as a resistance. And on any near-term choppiness, I think the worst case scenario is to get up to the 90%. In fact, we kind of need that, because the range right now on the monthly basis on the VIX is extremely low. It's less than 2 points. If we went into December with that, and that's maybe a little bit more of a bigger of a range if we fall down towards, say, like 11 or towards 10. In that area, like sub 11, we might get, like, say, a two plus point or maybe up to 3 point range, which is still way below half of the average true range on a monthly basis. If we go into December like that, it's going to not be a good. Those kind of moves typically lead to big moves to the upside. And considering the tariffs, expectations of tariffs being released in December, it'd be nice to get a little bit of an exhale now, heading into that, versus having it all pent up heading into December, which, as we've seen in the past, the longer we inhale without a good solid exhale, then when we do get that exhale, it's very uncomfortable. And that's kind of where we're leading right now. So it'd be nice to it'd actually be a good thing for us to get a good exhale before we head into that important December month. All right, so to summarize, we maintain a strong bullish posture, bullish expectations going into the end of the year. We are strongly overbought in the short term. Multiple things that show us that. We have been strongly overbought in the short term for a few weeks, so we can still maintain short-term choppiness, but we're getting to the point where we are really long in the tooth on this near-term run by different measures, which is increasing the likelihood of a pullback. That doesn't mean necessarily we have to pull off our bullish trades. That's hardly what we've done in our videos here and in our in our class. But it also doesn't mean that I can't reduce my risk a little bit with the types of trades I'm adding on right now, like we did on Friday, like we'll do here today. So what do you think? Do you agree or disagree with that assessment? There's a link popping out right there in the top right corner of your screen. It opens up a poll. Hit either agree or disagree. If you click disagree, comment down below on why. What are you seeing? Not just your opinion. Everybody has their opinion on what the market should be doing. I don't want to hear your thoughts on what the market should be doing. What I'd like to hear is what's driving that opinion. What chart are you looking at? What indicator, what macro indicator are you seeing that suggests that we should be maybe pulling back more than we have been and start to potentially reconcile this divergence that we see and these strong overbought measures that we're seeing. All right, if you look at over here on the left-hand side of the chart, you can see it's a pretty risk-off day. Real estate, gold, bonds, long-term bonds are up today. Some diamonds were up. On the other end of the spectrum, commodities were down, agricultural and consumable type commodities. Emerging market bonds, small cap stocks, the dollar was down. So it was a little bit of a risk-off day, and that's been a theme over the last week. Going into today and even with today, you can see safe haven assets have been bouncing. There's gold right there. And risk asset classes, emerging markets, small cap stocks, high yield bonds, all lagging. Crude oil, all lagging behind their safety counterparts here. So this little safety trade bounce, right, because it's been selling off hard, this safety trade bounce is kind of suggesting, that it's a little oversold and it's bouncing up. And the one thing we haven't seen, and everything else has pulled back, especially these international stocks that have also been so bullish, everything else has been pulling back. The only thing that hasn't has been the S&P 500. From a news standpoint, and it tends to get pretty light whenever the markets, when there's no news driving, you tend to get these kind of bounce backs and overbought and oversold conditions. The home builders survey was the only thing that was due out today, and it came in a little bit below expectations. You can see that even at 70, it's still a pretty high mark, we've been doing really well. In fact, if you take a look at the last year, it's bounced up earlier than anything else has, right? All the other indexes have peaked in August of 18, and you don't really see that as well here, but you kind of it peaked over in this August of 18 area, October right here, and then it fell. Well, everything else is still kind of down, while the home builder sentiment survey is continuing higher, even if it's only down a little bit this particular release. If you take a look at the economic surprise index, it's down, a little negative from what it was, and on the global basis as well. It's in fact, it's kind of been compared to the summer of 2016, coming off of those death cross lows of early 2016. We made a strong run higher in the summer and then pulled back by the elections, and similar to what we're seeing here, and then bounce back up. And so that's kind of the expectations, again, considering that a lot of these economic reports have been kind of they're expect to start bottoming out here after peaking in August of 18 and kind of starting to cycle higher here. It's another reason for this idea of being towards the beginning of a long-term move rather than the end. October of 18, when a lot of those indicators were really high and were rolling over on a long-term basis, year-over-year basis, then you could say we're a lot closer to the end of a long-term move. But that's the complete opposite now. So again, kind of suggests we might be the beginnings of a long-term risk appetite move instead of the end, like a lot of people think we have been, because they compare what we're doing now to January of 18, which is not even close to it's a much, much different environment in terms of risk appetite now as it was then, at that particular time. If you take a look at the different global markets, you can kind of see here again, it's good to see dark green shading all across the board, and where we don't see the dark green shading, we see pink and yellow lines. Brazil's probably the weakest that we have right now. It's pretty well below the moving average, but India and Russia are showing light pink shading and not even a yellow line. So we have some pullback patterns here, but for the rest of them, we are well above strongly rising moving averages. So very, very broad rally, if not in U.S. stocks, at least globally across all these different major economies. Let's take a quick look at how like the dollar and some of these different major signs are doing. You can see the dollar continue to pull back, and now is back to a red line in dark pink shading, so back to a bearish posture. That's actually really good for stocks, and especially international stocks. They will do well. If you take a look at TLT and GLD, again, you can see the overbought bounce we got back up to the moving average. So light green shading and not even a yellow line yet. And you take a look at gold, which on one hand does well in the bearish dollar market, but doesn't have to do well in the bearish dollar market because it's also a safety trade. It's also got the light green shading, bounce off of really oversold conditions. So that's kind of what we've got right now. And like I said, the Russell's pulled back, among other risk assets. You take a look at crude oil too. It has stalled during this rally. It hasn't been nearly as bullish as equities have been, and a pretty significant drop today that we had on crude oil, but only one that, as of right now, depending upon how we close here, this futures contract that just barely started, you got a bullish buy the dip signal here with the momentum line oversold and the strongly overbought. So we'll see how much more the crude oil pulls back. I actually kind of expect it will pull back a little bit, probably towards 56, as there's a little bit more of a risk off move that comes out of more than just international stocks and small caps, bleeds its way over into large caps too. All right, if we take a look at the different sectors and how they're performing, again, very broad, except in a few areas, utilities and real estate, and they're showing the same, and staples a little bit too, but they're showing the same oversold bounce back up to this moving average, and energy is kind of pulling back with more than any others, as not surprising because that's the weakest sector that we have. But everything else is strongly bullish and close to oversold or overbought clusters in healthcare and communication services and technology. And we got strong bullish patterns across a lot of these cyclical areas, financials, industrials that have been so weak, healthcare that have been so weak. They've really taken off. So again, kind of another sign of how broad this is and how any expectations of volatility would just be limited to the same type of move that we see here in utilities and real estate, where it just be an overbought drop down to support, and then a continuation of this strong trend that we're seeing across all these different areas. If you look at just today over here on the left, you can see real estate staples were your bigger winners. Communication services, to agree. Remember, communication services is kind of this bifurcated sector where some of it behaves like utilities and others behave more cyclical like technology and discretionary, which both did really well today too, outperforming the broader market. The biggest loser really was in energy and industrials, healthcare, kind of overbought. So some overbought areas still, pulling back a little bit. And again, that's more of an expectation that you would expect to see a little bit broader than we have been, mainly because you've had such an oversold bounce in these safety areas that's kind of helped alleviate any kind of slowness, because you see how sideways we've been in some of these sectors like industrials and financials that have been so bullish. Well, now they're kind of flattening out. Materials as well, they're flattening out here, but that flattening out has been offset by some really strong bullishness in real estate, utilities, and staples over this past week. All right, for our trade idea of the day, which again, we've already put on. We've already put it on in our live video that we do at 3:30 Eastern. But let's take a look at in the communication services sector, in the one of those utility type companies, Verizon. You can see it's we've been strongly bearish with dark pink shading here the last couple of days. Red line now, we're below a falling moving average. You take a look at the 3 green arrow chart. We are below the 8-day, and the 8 and 17 have come below the 30. The orange line's down. The stochastics has dropped below 50. If you take a look at the RSI and CCI for Verizon, you can see that we haven't quite dipped below the 40 level and the negative 200 level, which really kind of confirms the trend, the downward trend. Same thing with the Ichimoku cloud. We've broken into the cloud, but which is kind of the beginning, and we're below the blue both lines, so it's kind of the beginnings of bearishness, even if we haven't really gotten strongly bearish yet either. And another sign that the bearishness is we're leaning that direction is the Bollinger Band, or we're obviously in the lower half of the Bollinger Band width, but we're also into the value area. So we broke down into the value area, into this kind of lower volume area with potential of dropping towards 58, 57 and a half. So again, it's not a strong bearish pattern. I'm not going to buy a put here and make a strong directional move. I don't think there's that opportunity there. But there definitely is opportunity for us to stay below this volume node and this value area resistance level. And so we can look at coming out to December and selling the $60 put and buying the 62 for some protection. If we take a look at what that looks like here on a single symbol, you can see that you have a pretty decent probability. Well, let's go to December. You have a pretty decent probability of success. You set that break even onto the chart. There we go. Right there, and you can kind of see that we've got to get above that volume node before we break even, and and a little bit beyond that is where we would end up taking a loss. And we would take, since we're trying to go for 378, we would take a $378 loss. And if we get, there's been a few Market Outlook trades that we've closed here, and I've shown that. In fact, today in the Market Outlook Live, I closed an old vertical spread because we hit the 50% mark really quickly. You can see how we can get 50% quickly, and then it takes forever to get the other 50%. So if we can get 50%, great. it takes a pretty decent move for that to happen. You can kind of see we have to go from right this level pretty far, probably down to 58. But if we were to make a move down to 58 pretty quickly in the next day or two, or within about a week or 10 days, then we'll take that gain instead of waiting for the rest of it and employ that capital, this $1,000 of risk, employ it somewhere else and try to make the other half faster on a new trade instead of waiting all the way to expiration. And you notice without the earnings, there's no real risk here on December 20th. I mean, you do have a little bit of risk before expiration with the trade tariffs, which will be the same risk for everybody. But we were able to, because of the lack of the earnings and that trade tariffs, which right now the market just doesn't care about. We're able to put on a full position, right? Not a big position, but a regular full position, instead of keeping it smaller when we have different risk events that we need to account for with smaller position sizing. All right, well, that wraps us up for today. As always, you've heard from me now. Now I want to hear from you. So let's keep this conversation going in our Market Outlook forum. There's a link popping out right there. Click on that link, open up a thread, ask any question, post any comment you have about anything we talked about in the video today. If you have something on your mind, let me know, and let the rest of the community know, and let's keep this conversation going here. You can reply to other people's comments and questions as well. Remember, you have to be a subscriber to participate in our community, but I showed you earlier how to do that for free with that link in the top right corner of the screen. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on our video down below. Follow me on Twitter for more content. Join our Facebook group that we've created. Have a great rest of your evening, everybody, and we'll see you all tomorrow.